Welcome back, viewers. In this video, I am going to be showing you how to prepare consolidated financial statements using a question from the past papers. And this is the question. Let us go through the question. It is from the financial reporting past papers. So the question says, G Limited acquired 80% of the ordinary shares of 10 shillings per value in S Limited on 1st February 2023 at a cost of 3612 million. And then G Limited had acquired 3.6 million shares of 100 shillings per value at a cost of 488 million in B Limited on 1st November 2021 when B Limited's revenue reserves stood at 50 million. So from these 2 points, you can see that in the first one we are given the percentage of holding, 80%, which means that S Limited, which is the company being acquired, is going to be a subsidiary. And G Limited, which is the company that is acquiring, is going to be the parent company. So this is the cost of acquisition of the subsidiary. And the date of acquisition is 1st February 2023. In the second one, we are not given the percentage of holding, but you are given the number of shares that have been acquired, that is 3.6 million shares of 100 shillings per value. So we can use this number of shares to calculate the percentage of holding, which we are going to do later on. You're also given the cost of acquiring this company for 88 million, that is B Limited. You're also given the date when B Limited was acquired, that was on 1st November 2021. Then the financial statements of the three companies for the year ended that 1st October 2023 are provided below. So we have the statement of profit or loss of the three companies. We have G Limited, we have S Limited, we have B Limited. We have revenue, cost of sales, gross profit, investment income. We have the expenses. At the bottom, we have dividends paid. We have retained profit for the year. Below that, we have the statement of financial position as at that 1st October 2023 for the three companies, G Limited, S Limited, and B Limited. So you have the non-current assets, we have the current assets, we have equity and liabilities, non-current liabilities, current liabilities, and then we have the additional information. Number 1 says, on date of acquisition, so this is supposed to be the date of acquisition. So on the date of acquisition, the fair value of identifiable net assets of S Limited, and S Limited, we have seen S Limited is the one given in the first sentence, which we have said is a subsidiary. So number 1, you are told on the date of acquisition, the fair value of identifiable net assets of S Limited approximated their carrying amount except for an item of plant whose fair value was in excess of its carrying value by 150 million shillings. This item of plant had a remaining economic useful life of 5 years. So there are 2 adjustments we are going to be making for additional information. Number 1, there is a revaluation gain which is 150. We are going to add this 150 to the value of property, plant, and equipment during the consolidation. And then the asset, the plant, you are told it had a remaining useful life of 5 years. So that means depreciation is going to be adjusted. We are going to calculate depreciation based on the gain in revaluation, and that is going to add on the expenses. In number 2, you are told on 30th September 2023, S Limited sold goods worth 100 million shillings to G Limited, reporting a gross profit margin of 20% on this sale. G Limited had neither received nor recorded those goods in its books of account as at that 1st October 2023. So we have two workings here. Because this is intercompany sale of goods, we are going to eliminate the unrealized profit, the profit that was made by S Limited. That is 20% of the sales value, because you are told that the goods had not been received nor recorded, so which means all the goods are still within the group by the end of the year. And then because they have not been received, again, we are going to take them as goods in transit. So you're going to have two workings, one for unrealized profit, another one for goods in transit. Number 3, the group policy is to measure the non-controlling interest at their proportionate share of net assets in the subsidiary at the date of acquisition. So this means because you're not given the fair value of non-controlling interest, we cannot be able to use the full goodwill method. So the only method applicable in this case is the partial goodwill method. Then number 4, the intercompany outstanding balances between G Limited and S Limited did not agree due to goods in transit as per note 2 above. As at that 1st October 2023, the trade receivables of S Limited included 60 million due from G Limited. Amount due from B Limited to G Limited stood at 20 million shillings. So this note number 4 deals with intercompany debts. So when it comes to intercompany debts, we are supposed to eliminate them as long as the debt is between parent and subsidiary. But when the debt is between the holding company and the associate, we don't eliminate, because we don't consolidate associates' assets with those of the parent. So it is only between the parent and the subsidiary where the intercompany debts must be eliminated. Number 5, any goodwill on acquisition of the subsidiary or associate is considered impaired by 20%. So required: A, consolidated statement of profit or loss for the year ended at 1st October 2023. B, consolidated statement of financial position as at 31st October 2023. So this is the question I'm going to be solving. And you can get a copy of this question by checking the video description. There is a link there which you can use. You can click that link to get a copy of this question to help you to follow along as I show you how to solve the problem. So the first thing in every consolidation question is to calculate the percentages of holding if those have not been given. So because we are given one, that is for the subsidiary, we need to calculate the other one so that we can know whether B Limited is another subsidiary or B Limited is an associate. So how do we do that? We have the formula here. Percentage of holding, this one is in associate or in any other company. Percentage of holding can be found as follows. You take the number of shares acquired, you divide by total number of shares in associate, and then you multiply by 100. So number of shares acquired, we are given that in the question. Number of shares acquired, G Limited had acquired 3.6 million shares in B Limited. So we already have that one. So we are supposed to divide by total number of shares in associate. if you are not given the total number of shares, this is how we can find them. Total number of shares in associate is equals to the value of ordinary shares in shillings as given in the statement of financial position, divided by the par value, that is the nominal value of one share. So if you go back to the question, you will see the par value. This is for B Limited shares, is 100 shillings. So go down to where we have the statement of financial position. You look at the ordinary share capital of S Limited. This is 1.2. So if you go up, the amounts are shown in millions of shillings, which means this is 1200 million shillings or 1.2 billion shillings. So we take this figure, the 1.2 billion, we divide by the value of one share, the par value. That will give us the total number of shares that B Limited has. So 1.2 billion or 1200 million shillings, you divide by 100, which is the par value, it will give you 12 million. So this means that the total number of shares in associate is 12 million shillings. So take the number of shares that were acquired by G Limited, 3.6, divide by 12 million, the number of shares in associate, multiply by 100, that will give you 30%, which means B Limited is an associate. So if the percentage is between 20% to 49%, then the company that has been acquired is considered to be an associate. So now that we have the two percentages of holding, we have the 30% and we also have the 80% for the subsidiary, we can proceed to the next thing, which is calculation of goodwill. But for us to be able to find goodwill, there is something important that we have to find first. It is called pre-acquisition profit. So pre-acquisition profit, this is the profit that a company had on the date when it was acquired. It is the accumulated profit the subsidiary had or the associate had as at the date of acquisition. So dates are very important when it comes to consolidation. So let us go back to the question so that we can look at the dates when each company was acquired. So in the first one, G Limited acquired 80% of the ordinary shares of 10 shillings par value in S Limited on 1st February 2023. That is the date when S Limited was acquired by G Limited. Then if you go down to the statements that we are preparing statements for the year ended 31st October 2023. So if the year is ending on that 1st October 2023, when did that year begin? So you go back 12 months, you will see that the year began in 1st November 2022. So from 1st November 2022 to that 1st October 2023, those are 12 months. And subsidiary here was acquired on 1st February 2023. So the pre-acquisition profit in S Limited is the profit S Limited had as on this date, was on 1st February 2023. That is what we call the pre-acquisition profit. So how do we find it? So this is a diagram to help you to understand clearly how we obtain the pre-acquisition profit. So this is when the year began. So the year began on 1st November 2022. Acquisition took place on 1st February 2023. that is the acquisition date. The year is ending on that 1st October 2023. The period between 1st November, when the year began, to the time when the subsidiary was acquired, that is 3 months. 3 months. The period between when the subsidiary was acquired to the end of the current financial year, those are 9 months. If you go to the income statement, you are going to see the profit that was made between 1st November and that 1st October. So let us go back to the question and see what profit S Limited made. So this is the statement of profit or loss, and it is for the year ended that 1st October 2023. So at the bottom, we have the retained profit for the year. This means it is for the whole year, which began on 1st November and ended on that 1st October 2023. So 120 is the retained profit for the year for S Limited. So we go back to the pre-acquisition. So 120 is the profit that S Limited made for 12 months, beginning on 1st November, ending on that 1st October. Part of this profit is going to be pre-acquisition. These are 3 months. So profit for 3 months was made before the acquisition time, which makes it a pre-acquisition profit. Profit for 9 months was made after the date of acquisition, which makes it a post-acquisition profit. So this line here, this dotted red line, separates the two periods. So this side is the pre-acquisition period. From the line to the right side, this is the post-acquisition period. For us to calculate the goodwill, we use the pre-acquisition profit, not the post-acquisition profit. So what is the pre-acquisition profit? So we take the profit for these 3 months, which is 3 over 12 times 120, 30. Remember that this profit is just between 1st November to 1st February. And then we add whatever profit the subsidiary had from 1st November 2022 moving backwards. This whole side is pre-acquisition period. So it is going to be for these 3 months plus all the other previous years. Profit for first accumulated profit as at 1st November 2022 is given in the question. That is the one we call the retained profit balance carried forward. Retained profit balance carried forward. If it is not given in the income statement where you can normally find it, you can be able to find it by deducting. You take the profit given under the equity and liabilities. The retained profit for S Limited, we have 1950. This 1950 is accumulated profit up to this date, that 1st October 2023. And this retained profit of 1950 includes the profit made in the current year of 120. So if you take 1950, you deduct 120, you are going to get the retained profit at the beginning of the current year. So these are the workings. The entire profit, 1950, is made up of both post-acquisition and pre-acquisition profit. So if you want to be left with the pre-acquisition profit, you take the total profit, you deduct post-acquisition profit. The balance will be pre-acquisition profit. So pre-acquisition profit is equals to 1950. 1950 is the total profit as at the balance sheet date, 1950 of S Limited. So you take that profit you deduct post-acquisition. Post-acquisition is from this line all the way to that 1st October 2023, which is 9 over 12 times 120, which is 90. So if you take the total profit in the balance sheet, 1950, you deduct this post-acquisition profit, you're going to be left with pre-acquisition profit. Once you have this, now you can go ahead and calculate goodwill in subsidiary. So this is how goodwill in subsidiary is calculated. Because the fair value of non-controlling interest was not provided in the question, we can only use the partial goodwill method. In the partial goodwill method, we normally take all items classified under equity, we multiply by the share of the parent. So items classified under equity, so you can go back to the question, you go to the statement of financial position, under the equity section, take all the items shown there, you take from S Limited. S Limited, take the ordinary share capital, that is 2,000. Take the share premium, that is 400. Take these ones to the cost of control. You multiply by the share of the parent, which is 80%. So 80% of 2,000, 1,600. For the share premium, the same, 80% of 400, 320. So when it comes to profit, we don't take the whole profit as given in the balance sheet. We take only the pre-acquisition profit. So if you go back to the question, the retained profit 1950 is made up of both post-acquisition profit and pre-acquisition profit. But according to our workings, we have been able to identify pre-acquisition profit as 1860. This is the one we are supposed to use in the cost of control account. So 1860, we multiply by 80%, which is the share of the parent. It gives us 1488. So those are the three items that were shown under the equity section. Revaluation gain is normally not given in the balance sheet. You are going to find it in the additional information, but it is also an equity item. So if you go back to the question, we have exhausted all items under equity. Then you go to the additional information. There is a revaluation gain of 150 million. So this is for the assets of S Limited. It says, on the date of acquisition, the fair value of identifiable net assets of S Limited approximated their carrying amount, except for an item of plant whose fair value was in excess. So in excess means it was a gain. In excess of its carrying value by 150. So the amount of gain is 150. It was as at that date of acquisition. The parent is going to take 80% of 150, it is going to be 120 millions. So once you have shown all the items that are classified as equity, bring the cost of investment. The cost of investment is provided in the question. At the very beginning of the question, the first sentence, where we are given the date 1st February 2023, we are given the cost that G Limited spent to acquire S Limited, which was 3612 million. So this is the cost of investing in S Limited. In some cases, this cost may not be provided. And if it is not provided, you can look for it under non-current assets in the statement of financial position. That is the parents column. So the amount we have seen above is already included in this figure, this investment figure of 4.5 billion. So let us take this amount, that 612, that is the purchase consideration. the cost the parent paid to acquire S Limited. So once you have recorded the cost and the equity items, the balancing figure becomes the goodwill. Goodwill is going to be 84 million, which is the difference between the cost of acquisition and the fair value of net assets acquired. Once you have the goodwill, look for the rate of impairment, if there is any. So the question, the last point, number 5, you are told any goodwill on acquisition of the subsidiary or associate is considered impaired by 20%. So you calculate that. You take 20% of 84, it will give you 16.8. And because this is a partial goodwill, this goodwill is only for the parent. The minorities have no share. So goodwill impaired will not be shared by the minorities. So these are the entries. This is how we are going to account for the goodwill impaired. We are going to debit group profit and loss. And when I say group profit and loss, I'm referring to the retained profit account, because that is where we are going to do the actual adjustments. Credit goodwill account 16.8. So we are going to make these adjustments later on. So after we have the goodwill for subsidiary, let us calculate goodwill for B Limited, that is the associate. So take the cost of acquisition. Cost of acquisition 488. Back in the question, that is what we were given in the question. G Limited had acquired 3.6 million shares of 100 shillings per value at a cost of 488. This figure, 488, has also been included in this figure, 4.5, which is the investment as recorded by the parent before consolidation is done. So take the cost of acquisition, 488, less fair value of assets acquired. So we do the same thing we have done for the subsidiary. Go to the balance sheet, the column for B Limited. Take the ordinary shares, take the share premium, multiply by the percentage of holding of the parent. So this percentage, we have already calculated the percentage of holding in associate, which is 30%. So go to the equity section for B Limited. Ordinary share capital, B Limited, is 1200. Share premium, B Limited, is 300. So bring them to the computation of goodwill. You take 30% of the 1200, 30% of the 300, and this is what you are going to get, 360 and 90. For the profit, we only take pre-acquisition profit. In the question, you are given retained profit 300. This 300 includes the post and the pre-acquisition profit. However, in this question, you are already given the pre-acquisition profit, so you don't need to do any calculations. You are told on 1st November 2021, when B Limited's revenue reserves stood at 50 million. So this is the revenue reserves, the retained earnings B Limited had as at the date of acquisition. It was acquired a few years ago, because this year began on 1st November 2022. So this one was acquired about 2 years ago. But you are given directly the pre-acquisition profit, which is 50. So you multiply the 50 by 30%, you will get 15. So we are not given any revaluation gain for the associate. So these are the only items we are going to include here. So take the cost of acquisition, deduct all these items. The balance you get here is goodwill. or you can also call it premium, 23. The impairment rate that we were given is the same for both subsidiary and associate, 20%. So take 20% of this goodwill, you will get the impairment for the year, 4.6. This 4.6 is going to be recorded as shown here. We are going to debit group profit and loss. That is the retained earnings. And then we are going to credit investment in associates account, which we are yet to prepare. So now that we have goodwill for both companies, we also have the goodwill impaired, we can move to the next thing. Actually, we don't need to do a lot of workings. We can go straight to the first requirement, consolidated statement of profit or loss, without even having to go through all these workings. In fact, you can just start with this one even without doing any workings. So these 10 marks are very easy to get because no workings, the additional informations will not even affect your preparation of the consolidated statement of profit or loss. So this one is very easy. First, we don't consolidate associate. We don't consolidate income and expenses of B Limited, which is the associate. Consolidation means adding income and expenses of the parent to those of the subsidiary. That is what we are going to do. So you are going to follow the same format which is given here. Exactly what is shown here. You take the items in the column of G Limited. You add to the items in the column of S Limited. Do not multiply by 80%. However, you are going to make changes because S Limited was acquired in between the year. We have seen that the post-acquisition period, since the acquisition date to the end of the current year, the time when you are preparing the statements, those are 9 months. So the parent is not entitled to show this profit in the current income statement because this one was made before the acquisition. The parent is only going to take income and expenses of the post-acquisition period, which is only 9 months. Therefore, we are going to multiply all the items in S Limited column by 9/12. Just that, then whatever we get, we add it to that of G Limited, and we will have the consolidated income statement. So this is the consolidated statement of profit or loss prepared by the parent, G Limited. So revenue, we have taken the revenue of the parent, that is 600. Revenue of G Limited, that's 600. And then the next one for S, 1500. You are going to multiply it by 9/12. 9/12 is the same as 0.75. So you multiply the revenue of subsidiary, then whatever you get here, you add to that of the parent. You record the amounts in this column. You are going to do the same with the cost of sales. You're going to do the same with all the expenses. You're going to do the same with all the expenses as you record them on this column. The only working here you're going to make is for the investment income. So let us go back to the question. You are given here investment income 150. Investment income comes from various sources. It can come from rent, it can come from dividend received, it can come from interest. Part of this investment income is the dividend that G Limited received from S Limited and also received from B Limited. Because at the bottom of the profit and loss, you are given the dividends paid. S Limited paid a dividend of 120. That dividend, 80% of it would go to G Limited, 20% would go to the minority. Similarly, the other company associate, B Limited, paid a dividend of 100. 30% would be received by G Limited and 70% by the other investors. So the dividend that is payable to G is supposed to be deducted. That is what we call intercompany payment, intercompany dividend. To S Limited, the dividend is an expense. To G Limited, the dividend is an income. It is supposed to cancel out. So when you go to the profit and loss, you take the 150. 150 is the investment income recorded by G Limited. 150. Deduct 80% of 120, which is the dividend that would go to G Limited. 120 is the total dividend paid by S. So 80% of that, 80% of 120, and then again you multiply by 9 over 12 or 0.75, because that is the post-acquisition period. They were together for 9 months only. So you cannot take dividend for 12 months if the parent stayed with the subsidiary for 9 months. So we are going to deduct this. This is the dividend received from a subsidiary. The next one is the dividend received from associate. 0.3, that is the percentage of holding, which is 30%. 100 is the dividend paid by the associate. So the associate paid a dividend of 100. 30% of it is going to be received by G. So we deduct dividend from associate. We also deduct dividend from subsidiary. Whatever is left, 48, this is income from other investments, maybe from other companies, maybe from rent. That is the one that we record after eliminating the intercompany dividend. So the other part of the expenses, we don't have any adjustments. We just take the expense of the parent, add 9 over 12 multiplied by expenses of the subsidiary. You record the totals there. So difference now will come after we obtain the profit after tax. The profit after tax, 1348. Below that profit, you are going to add share of profit from associate after tax. So the profit that was made by the associate, the parent or G Limited is supposed to take 30% of it. So if we go back to the question, we go to the statement of profit or loss, B Limited's column, look for profit before tax, not before tax, after tax, but before dividend. Profit after tax in B Limited is 180. That is the associate, is 180. So the parent is going to take 30% of it. So remember that the associate was acquired 2 years ago. Therefore, we are not apportioning this. We are not apportioning this profit because the company stayed with the associate for the entire financial year, 12 months. So we are supposed to add that share of profit from associate after tax, 30% of 180, which is 54. Then we less minorities' share of profit. So the parent has taken everything from subsidiary. Even though the parent holds 80% of subsidiary, here the parent has taken 100% of those income and expenses. So we are supposed to deduct the share that belongs to the minority. So if the parent holds 80%, it means the minority's share is 20%. That is why we have 0.2 here. Multiply this by profit after tax in subsidiary. So we go to the income statement, statement of profit or loss, the subsidiaries column, that is S Limited. Check for profit after tax, it was 240. So minority will take 20% of this. So 20% of 240, and then because acquisition, the post-acquisition period is 9 months, we don't take all of it for 12 months, we only take for 9 months, which is 0.75. We deduct it. So after you have done all the additions, all the arithmetics here, the balance, the last balance you have here is called profit attributable to parent. Because you have eliminated what belongs to minority, now what remains is what belongs to the parent. And this is what we are going to take to the retained profit account. So that is all for the consolidated statement of profit or loss. It is usually the easiest part of the consolidated financial statements. As you can see, we did not deduct any goodwill impaired here. We are going to do that in the group retained profit account. So most of the workings now will begin after you have prepared the profit or loss statement. So we have a bunch of workings that you're supposed to do. Before you can prepare the retained profit account, we must go through all the additional informations and do the required workings. So we have the first additional information that was dealing with revaluation gain. So going back to the question, let us look at the additional information number 1. You are given the revaluation gain is 150 million. And then the plant, you are told it had a remaining economic useful life of 5 years. So we are supposed to calculate depreciation adjustment based on the gain in revaluation. Reason being, initially, depreciation was calculated before the revaluation was adjusted. So after the revaluation has been adjusted, we are required to adjust the depreciation. So that is the working that is happening here. Revaluation gain is 150. Depreciation on revalued amount is the gain itself divided by the useful life, which is 5. It will give you 30. And because all expenses were apportioned pro rata to time, we took expenses for 9 months in subsidiary, not 12 months. There is no reason why we should not apportion the depreciation. We take it also for 9 months. So we multiply by 0.75, which is 9 over 12. We get 22.5. So once we have the depreciation adjustment, these are the entries that will be made. But because the asset belonged to the subsidiary, the minorities will have a share. So we will debit the group profit and loss, or the retained profit, with a share of the parent, 80%, which will give us 18. Then we debit minorities' interest, 20% of 22.5, which will give us 4.5. Then with the whole amount, we are going to credit assets account with 22.5. So next we have goods in transit. Goods in transit, if you go back to the question, that was additional information number 2. You are told that on 30th September 2023, S Limited sold goods worth 100 million to G Limited. And then you are told that on 30th September 2023, S Limited sold goods worth 100 million shillings to G Limited, reporting a gross profit margin of 20% on this sale. G Limited had neither received nor recorded those goods. So the key word here is neither received. So if G Limited had not received these goods, they become goods in transit. If the goods had been received, we would not be calculating goods in transit. So goods in transit is the whole figure of 100 million. So anytime you have goods in transit, this is how we make the workings, the adjustments. Debit inventory account with the value of goods in transit. Credit group creditors with the value of goods in transit. So this is regardless of who was selling to who, whether it was the parent selling to the subsidiary or vice versa. These are the entries we always make. But when it comes to unrealized profit, we only calculate unrealized profit if the goods were not sold outside the companies. If the goods were sold to customers, all of them, we would not have unrealized profit. So were the goods sold to customers? So according to the question, the goods were not received by J Limited. So which means they are still within the group of companies. They have not been sold to customers. So the profit that S Limited made remains within the group. It is called unrealized profit. So how much profit did S Limited make on the sale of these goods? So S Limited sold goods worth 100. 100 is the selling price, reporting a profit margin of 20%. So the profit is 20% of 100. Unrealized profit is equals to the profit margin times the sales value of the goods, 20% of 100, which gives us 20. And then how do we make the entries? It all depends on which company is selling to the other. If the parent is selling to the subsidiary, the entries are slightly different from when the subsidiary is selling to the parent. So let us go to the question and see which is selling to the other. S Limited sold goods to G Limited. S Limited is the subsidiary while G Limited is the parent. If the subsidiary is the one selling to the parent, it means the minorities will have a share on that profit. But if it is the parent selling to the subsidiary, it means the minority will not have a share because minorities are in the subsidiary, not in the parent. So therefore, because here the subsidiary is the one that made that profit, minorities will have a share. So the entries will be as shown here. We are going to debit group profit and loss account 80%, which is the share of the parent, 80% of 20, which is 16. Then we debit minority interest account with 20%, which is the share of minority, 20% of 20, which is 4. Then with the whole amount, we are going to credit group inventory account with the whole amount 20. So after we have done these workings, now we can go ahead and prepare the retained profit account because these items are going to be adjusted there. Anytime we say debit group profit and loss, group profit and loss, it means these items will be reflected in the group retained profit account. So you need to understand the format of the group retained profit account. Although different people may use different formats, when you follow the format correctly, you're supposed to arrive at the same answer. So this is the format which I find a bit easier to work with. On the credit side, you start with the balance brought down of the parent only. Balance brought down means the retained profit as at the beginning of the year. If you are not given that, There's a way you can find it. So go back to the question, go to the equity section, retained profit. So how much retained profit did the parent have? It was 2,500. This retained profit is as at the end of this year. It includes profit for the current year. If we deduct profit for the current year, we are going to be left with profit as at the beginning of the year. So how much profit did the parent make in the current year, which was retained after everything was paid? So retained profit for the year was 670 for the parent. So this 670 is already included in this figure of 2,500. So if you take 2,500, you deduct 670, you're going to be left with profit as at the beginning of the year. So that is what is happening here. Take the retained profit at the end of the year, deduct retained profit for the current year, you'll be left with the balance brought down of the parent, the retained profit as at the beginning of the current year. So once you have recorded that, because we say here it is parent only, so do not bring balance brought down of the subsidiary or the associate. It's supposed to be parent only. From there, bring the retained profit for the current year, which is the answer you got in the profit and loss statement. So if we go back to the profit and loss statement, our last item there, that was called the profit attributable to parent, 1366. That is the one we are bringing here, 1366. Retained profit attributable to the parent for the current year. From there are two items we are supposed to add. One is share of post-acquisition profit of associate, excluding the current year's profit, because the current year's profit has already been included in this figure of 1366, because we added share of profit from associate for us to arrive at this figure of 1366. So we cannot add it back here again, it will be double counting. So we are supposed to bring post-acquisition profit of associate, not including the current year's profit. Similarly, we do the same thing with the subsidiary. We're supposed to bring share of post-acquisition profit of subsidiary, excluding the current year's profit. We exclude the current year's profit because it has already been included in retained profit for the year attributable to the parent. So because we acquired the subsidiary 9 months to the end of the current financial year, all post-acquisition profit from subsidiary has been included in this figure of 1366. So we have 0 remaining. We don't have any other post-acquisition profit apart from what the parent got in the current year. But because the associate was acquired about 2 years ago, there is part of post-acquisition profit which has not been included in the retained profit for the current year. So how do we get it? Take the profit as at the balance sheet date, the end of the current year. If we go back to the statement of the financial position, under equity, go to the column of the associate, B Limited, look for the retained profit. It is 300. This 300 is both post and pre. But according to the format, we don't want pre. We don't want pre-acquisition profit in the associate. So therefore we deduct it. At the top we were given the pre-acquisition profit was 50. This 50 is included in this figure of 300. And that 50 is pre-acquisition. So we deduct it so that we are left with post-acquisition profit in associate. Also, if you go to the current year, B Limited made a retained profit of 80. This 80 is the profit for the current year. Again, we want to exclude profit for the current year because that has already been considered in the consolidated profit and loss statement. So you're going to take this retained profit. First, we deduct pre-acquisition, which is 50. Then we deduct current year's retained profit, which is 80. So that is what is happening here. 300, deduct 50, which is pre-acquisition, deduct 80 because we said excluding current year's profit, and 80 is current year's profit. So what you are remaining with is post-acquisition profit excluding current year, and because we have said it is a share, the parent will take its share. The share of the parent is 30%, so multiply by 0.3 or 30%, that will give you 51. So those are the only items we show on this credit side. When you go to the debit side, we are supposed to deduct dividend paid by parent only. Dividend paid by associate is not shown. Dividend paid by subsidiary should not be shown. So back to the question, how much dividend did the parents pay? Dividends paid by parent was 600. So that is what we are supposed to show here. And then apart from that, all the workings where we were saying we are going to debit retained profit or the profit and loss, all those things are supposed to be recorded here. For example, we had depreciation adjustments, 18. So let us go back to the workings and see how we arrived at 18. This was the revaluation gain. So revaluation gain, we did some workings here. The revaluation gain was 150. We divided by 5. We multiplied by 9 over 12. We got 22.5. Then the share of the parent was 80% of 22.5, which was 18. We said we were going to debit group profit and loss. That is what we are doing here. We have debited the group retained profit account with the depreciation adjustment 18. And then there is the intergroup profit. This is the unrealized profit. So back to the workings, how did we get 16? So 16, after we found that unrealized profit was 20, we took the share of the parent, which was 80% of 20, that gave us 16. So that is how we got this 16. And then we have goodwill impaired in subsidiary as well as in associate. So we had done these workings. In subsidiary, the goodwill was 84, so we took 20%. In associate, the goodwill was 23, so we took 20%. So the goodwill impaired is going to be recorded here. So once you find the balancing figure, of course, the credit side is going to be more than the debit side. So the balance carried down will be on this side, which is 2591.6. This balance carried down will be taken to the statement of financial position under equity and reserves. So that is how the group retained profit is prepared. Next, let us see how to prepare the minority interest, also known as the non-controlling interest. So this one is very easy because we were not given the fair value of non-controlling interest. We can only take their share of net assets. We can only use this method. So back to the question, there was a point that was number 3 that said the group policy is to measure the non-controlling interest at their proportionate share of net assets in the subsidiary at the date of acquisition. Proportionate share of net assets. So the net assets, we normally take the equity items. So these are the equity items, and this is the subsidiary. Because minorities have a share of 20%, we are going to take 20% of 2,000, 20% of 400, 20% of 1950, because for minority, we don't separate the pre-acquisition from the post-acquisition profit. We just take the whole profit as shown in the statement of financial position. So these three items are going to be taken to the minority interest account. Each one you multiply by the percentage of the minority. The ordinary shares, the share premium, and the retained profit we have taken as it was given in the statement of financial position, 20% of it. This is what we get. The only other item that we include here, which is normally not given in the balance sheet, is the revaluation. Most often the revaluation will be shown in the additional informations. So the gain itself was 150. So remember, when we were preparing the cost of control account, we took revaluation gain of 150. We took 80% because 80% was the share of the parent. So when you go to the minority, you're supposed to show the remaining part of it, 20%. So here we are bringing 20%. In fact, when you look at all the items shown in the minority interest, these are the same items shown in the cost of control account, only that we took 80%. Everything we took 80%, and the profit was as at the date of acquisition. So all these items in the COC account, they also go to the minority interest, but here you take the percentage of the minority, and the retained profit is not pre, neither is it post acquisition, but both pre and post acquisition. Then on the debit side, these are the expenses where the minorities had a share. For example, unrealized profit. If you go to the workings for unrealized profit, we took 20% of 20. That was the minority's share, and then got 4. That 4 is the one we have here. For depreciation adjustment, we did the workings. Depreciation adjustment was 22.5. We took minority's share, 20% of that. We got 4.5. And that is what we have here. All those items where we are saying debit minority interest are supposed to be brought here. Once you have recorded everything, find the balance carried down. In this case, the balance carried down is 891.5. This balance carried down will be taken to the statement of financial position. The same place we are going to take the group retained profit, and that is the equity section. So the only remaining workings is investment in associate. Remember, we don't consolidate assets and liabilities of the associate together with those of the parent. Instead, we prepare an account called investment in associate account. And the balance of this account is shown as non-current asset in the consolidated statement of financial position. So if you understand the format for the investment in associate account, it is very easy to prepare it. On the debit side, we always record the cost of investment followed by the share of post-acquisition profit. On the other side, we show goodwill impaired. The difference between the debit side and the credit side is the balance carried down, which will be taken to the non-current assets. So cost of investment, this is what you are given in the question. This is what the parent paid to acquire the associate. It was given in the second paragraph. G Limited had acquired those shares at a cost of 488 million. So that is the cost of investing in B Limited, in the associate. This figure 488 is what we have here. So what about the post-acquisition profit? So post-acquisition profit, take the profit of the associate as at the balance sheet date, the one you are given in the statement of financial position. Deduct pre-acquisition profit. So what is remaining there is going to be post-acquisition profit. You take 30%. So this 300, the 300 is what we have in the statement of financial position in the column of B Limited. In the column of B Limited, 300. Because we want post, we have deducted the 50 million, which was the pre-acquisition profit. Because we have said it is a share of post-acquisition profit, we have multiplied by 30%, and that is how we have obtained 75. Goodwill impaired, we did the workings. The goodwill in associate was 23, and then we multiplied 23 by 20% and got 4.6. And then we said we were supposed to credit investment in associate with 4.6. And that is what we are now doing. We are crediting investment in associate with goodwill impaired of 4.6. So the balance carried down will be taken to statement of financial position as a non-current assets. So we have finished all the workings. The last thing is now to prepare the consolidated statement of financial position. And here we have it. It is not very complicated. The format we are using is the same format as given in the question, with a few items added. So let us go back to the question and look at the statement of financial position that was provided. Under non-current assets, we had only two items: property, plant and equipment, and investment. So during consolidation, we are going to add the assets of G Limited to those of S Limited, but we are not going to add B Limited because we don't consolidate associates. So 5,000 we are going to add to 4,200. That is what we are doing here. 5,000 we have added to 4,200. Then we have also added the revaluation gain of 150. We have deducted the depreciation on the revaluation gain, which was 22.5 in total, not the share of the parent or the minority, but the total depreciation adjustment, and that is how we have obtained this figure. So back to the question. We have investment. 4,500 for parent, 450 for subsidiary. During consolidation, we are supposed to add these two, and we are supposed to deduct the price G Limited paid to acquire S and the price G Limited paid to acquire B Limited. So we are supposed to deduct the cost of investing in S Limited, that is 612. We are supposed to deduct that. We are also supposed to deduct the cost of investing in B Limited, 488 million. So we are going to deduct those two. So 4,500 we deduct 488, which is the cost of investing in associate. We also deduct 3612, which is the cost of investment in subsidiary. And then we add 450, which is the investment shown in subsidiaries' assets. So the figure here we get is 850. So we are calling this other investments to differentiate them from investment in associate. Investment in associate, we are not going to do the workings. We are just going to transfer the balance we found in the investment in associate account, 558.4. That was the balance. So this is the balance we are transferring to investment in associate, 558.4. Then in the initial statement of financial position, we did not have goodwill. We only had two items. So we are adding goodwill and we are also adding investments in associate. We have already added the investment in associate. Now we also add the goodwill from subsidiary. So goodwill in subsidiary, we already did the workings. If you go to the workings we did, the goodwill was 84, and then the goodwill impaired was 16.8. We are supposed to deduct the goodwill impaired and record the net figure. So 84 minus 16.8 gives us 67.2. Those are all the non-current assets. The current assets are a bit easier, except for the unrealized profit, goods in transit, intercompany debts. We just add the current assets of the parent to those of the subsidiary. So if you go to the question, current assets, inventory, you are going to take 1200, you add to 900, and that is what we have done here. 1200 we have added to 900. But remember, we had goods in transit. And in our workings we said we were going to debit inventory with goods in transit, which is 100. At the same time, we were going to credit group inventory with an realized profit, which came at 20. So we add the goods in transit, 100. We deduct an realized profit, 20. We record the balance. Then we have trade receivables. Trade receivables, this is the receivables for parent plus receivables for subsidiaries minus intercompany debt. Intercompany debt should be deducted from both receivables and payables. This 60, it came from this statement, statement number 4. It said that the trade receivables of S Limited included 60 million due from G. S is the subsidiary, G is the parent. We only eliminate intercompany debts between parent and subsidiary, not between parent and associate. That is why we are not going to be adjusting the 20 million, because the 20 million is between B, associate, and G, the parent, and we do not consolidate assets and liabilities of associates and the parent. We also don't adjust intercompany debts. So we are going to deduct this from both accounts receivable and the accounts payable, because to one company it is an asset, to the other company it is a liability. So the 60 million has been deducted from the trade receivables. The same amount has been deducted from the trade payables. And it is not even going to affect anything, because the same amount you deduct from liabilities, you also deduct from assets. It will not have any effect on the balancing of the statement of financial position. We have cash and cash equivalents. We take the one for parent 400, add to that of subsidiary 300, we get 700. Total assets are coming at 15,423.1. We go to equity and liabilities. We have ordinary share capital. One thing you are supposed to note is that for ordinary share capital, we only include the parent only. We don't consolidate equity section. Share premium, we don't consolidate this part. We only show share premium of parent only. If you go back to the question, the ordinary share capital of the parent was 6,000. Share premium of the parent was 1,500. These two are the ones we are going to take. We are not going to add to the other ones for the subsidiary. So 6,000 and 1,500, those are the ones for parent only. When you go to retained profit, you just need to take your balance from the retained profit account. So we prepared the group retained profit, and the balance carried down was 2591.6. That figure is what was brought here, 2591.6. Then you bring the minority interest, the balance from the minority interest account. We already prepared the workings. The balance carried down from minority interest account was 891.5. This is the figure we are bringing here, 891.5. So minority interest and retained profits are supposed to be shown at the equity section along with the share capital and the share premium. From there we have non-current assets. We don't have a lot of workings here. You just add parent plus subsidiary. So note that the liabilities we consolidate, the assets we consolidate, but equity and reserves we do not consolidate. So the 10% loan stock, the parent had 800, subsidiary 1,000, so the total is 1,800. 1,800 is what we have here, 1,800. Deferred tax, the parent had 200, the subsidiary 560. So when you add these two, we get 760, and that is what we have here, 760. We go to current liabilities, trade payables. For the trade payables, the parent had 800, the subsidiary had 750. You add those two, and then you deduct intercompany debts. And then we have also added the 100, because in our workings, there is something we say. In our workings, for the goods in transit, we had said we were supposed to credit group creditors with the 100 which we debited in the inventory. This is what we are now doing in the statement of financial position. We are adding the 100 goods in transit because we are assuming you bought goods and you did not pay for them. So you increased your creditors, and then we are deducting the intercompany debts, and that is the amount we are getting. We have accruals. Accruals, the parent had 40, subsidiary 30. You add the two, you're going to get 70. That is what we have there. We have current tax. The parent had 160, the subsidiary had 60. You add the two, you're going to get 210. That is 220, 160 plus 60, and that is what we have there, 220. When you add the equity and liabilities. The total is coming at 15,423.1. So this total is the same as the one we had for all the assets, non-current and current. So this is 15,423.1 and this is 15,423.1, meaning our workings were correct. So this is the end of the video. Feel free to leave a comment. If there is a video that you would want me to record, a question you would want me to demonstrate on how to solve it, you can leave a comment below. I'm going to be doing another question similar to this one, because this one, in the computation of goodwill, we have shown the partial goodwill method. In the next question, I am going to be solving another one almost similar with a few different things. One of them being, we are not going to be using the partial goodwill method. Instead, we are going to be using the full goodwill method. So go ahead and watch the next video so that you can be able to understand how we normally treat the full goodwill method. Thank you for watching. Goodbye. See you next time.